Saturday, September 19th, 2020, Maneco 64, home of alternative economics and contrarian views. So the FT has done it again on a Friday. They've done a hit piece on silver. The last time they did that was Friday, July 3rd, when John Dizard of the FT wrote, "Don't bet on the silver boom. The industrial metal will not be dragged up by gold." So that was on July 3rd. Silver was trading around $18.05. A few days after that, it started moving higher and got to almost 30 by the beginning of August, of course, as we all know, or all the people that follow silver for that matter. And in that hit piece on silver, this is what he said, John Dizard, and I quote him again. "It goes along with owning a semi-automatic rifle with lots of spare ammunition, canned goods, conspiracy theories, contempt for urban liberals. They are way past voting Republican. The most committed are silver stackers who squirrel away stocks of silver coins to trade for essentials after societal collapse." So that's how denigrating John Dizard was. And he also rolled out a guy called Jeff Christian. So who is Jeff Christian? Well, he's the head of the CPM group. And this is what he says. "Metal markets professionals do not share that view." Jeff Christian is a metal market professional, right? CPM, an industry advisory firm that does not trade or sell the metals or related securities, has a house view that the silver price will not sink as they did in March, but are likely to trade above 16 and below 20. So that's what Jeff Christian said back in July. Of course, he could have been right, but he wasn't, right? Silver blew right through 20, went all the way to just below 30 right after he made those comments. So who is Jeff Christian? Because in the new hit piece by the same guy, John Dizard, he quotes Jeff Christian again, writes. So this Jeff Christian guy keeps popping back up. So I've had a look. I know who Jeff Christian is, but for all my viewers here, let's have a look here. CPM Group, right? Who we are. CPM Group is an independent commodities research consulting, commodities and asset management and investment banking firm that provides comprehensive research, analysis, and advisory services. Our advisory services are driven by the results of our research and analysis. CPM Group is the trusted advisor to producers, consumers, institutional investors, governments, regulatory authorities, and high net worth individuals regarding commodities market and the financial management of exposure to commodity-oriented investments. And this is the kicker here about Jeff Christian. Founded in 1986, CPM Group was created via a management acquisition of the Commodities Research Group at Goldman Sachs. So Mr. Christian started out, at the time, was working for a company called J. Aron. That was the commodities arm of Goldman Sachs, as you can see here. Goldman's J. Aron era ends with David Solomon's rise. So another guy who was part of J. Aron, who was in the bullion dealing department, was Robert Rubin, who eventually became Secretary of the Treasury, of course, under Bill Clinton. Before that, of course, he went to head Goldman Sachs. He also, after he finished his stint at the U.S. Treasury, he was hired by Citigroup. Why did Robert Rubin get hired by Citigroup if he used to be a Goldman guy? Well, because Robert Rubin and his successor at the U.S. Treasury under Clinton, Larry Summers, were instrumental in abolishing Glass-Steagall, in giving the investment banks and the commercial banks the wherewithal to combine into huge speculative machines that they became after 1999. It set the scene for the '08 crisis. It's been instrumental in this huge monumental bubble that we have. It's been instrumental in the fact that these banks have been bailed out many times over now, especially after the crisis that started last September, the repo market crisis. So as you can see, Jeff Christian is an analyst for the powers that be, for the bullion banks. So they're desperate right now. So they've wheeled him out again. So the second article says, where there is a silver tip, there is a silver tap. Investors shouldn't overestimate the demand for physical metals while market makers are at play, right? So let's go through this second John Dizard article. And the first one was sent to me by a friend of mine. I hadn't seen it on that day when it came out. And the one that came out yesterday, I sent it to this friend. And he said, how can the FT allow someone like that to write again about silver? And I said, well, because FT is part of the problem. And the FT is controlled by the same people who own the central banks, who own the bullion banks, the same people who pay Mr. Christian for his analysis, right? And if you don't believe me, look at this editorial the FT wrote back in 2004. I was so shocked by this editorial at the time. I was already stacking gold and silver. I was already a deplorable, according to Mr. Dizard, right? And this is what they said about gold. Going, gold. The pointlessness of holding bullion continues to sink in. Gold at the time was at $400.65, as you can see there. And I'm glad I didn't listen to the FT. I learned then that there's something wrong about this publication. I didn't quite know what it was, but now I know. They're owned by the same people who own the bullion banks. They don't want you in the precious metals, right? If you want to read this, freeze the video or pause the video, do a screenshot and read it, because I'm not going to go through this again. I've been through it many times before. So let's see what Mr. Dizard had to say yesterday. And I think he's quoting Jeff Christian again. So Jeff Christian is come on again to try to hit on silver, right? So that's why I think this is the silver bottom, the second silver bottom that the FT has called. So John Dizard says, there's a city of London saying that where there's a tip, there's a tap, or inside information is usually someone trying to sell you something. Around May and April, I started hearing more about silver. Nothing indiscreet, just that I should be thinking about it. In my usual contrary way, I wrote a silver skeptical column in July, pointing out what had happened to silver bulls in the past, notably the Hunt brothers in 1980. In the meantime, a sad story had been playing out in European bank corridors. There's a vast overstuffing and undercapitalization, which this year means some departments would have to go. The highest ratio of potential embarrassment to revenue would be the departments engaged in commodities, trade finance. Part of this collective decision had to do with the increased intensity of anti-money laundering efforts. And in fact, if you want to launder a large amount of money, entering into a multi-cornered commodities trade transaction is a pretty good way to do it. After all, 1 ton of an element such as niobium, gold, or silver is identical down to the atom to the next ton. So he's basically saying that the reason there's demand for precious metals is because of money laundering. But I guess he hasn't heard about HSBC, how they laundered billions of fiat dollars, right? For the drug cartel in Mexico, and how they're fined billions of dollars as well, right? Anyway, let's keep going. And there were always other compliance problems turning up, whether it's Americans looking for Iranian oil or overextended Asian traders. These attract fines that can be a multiple of business involved. At BNP Paribas and ABN AMRO Bank, the general downsizing of commodities finance was announced around the end of the second quarter. Other banks trimmed their commodities departments with less fanfare. This is what he's trying to tell us, right? That precious metals are doing well just because there's a lot of money laundering, and he doesn't talk about the fact that the Fed has doubled its balance sheet in the last few months, right? So let's jump to the part where he talks about silver. He starts talking about silver. And there was apparently a lot of silver to buy. London vaults, which really mean futureless warehouses near cargo airports somewhere in England, recorded their largest ever reports of silver on hand in March. 1,175,737,000 ounces, troy ounces. There was also a lot of gold on hand, but there were more buyers for that, including respectable ones like central banks. So Mr. Dizard thinks central banks are respectable. So that's the kind of guy he is, right? After all, gold is recognized as a monetary asset by the Bank for International Settlements right alongside other non-exchange controlled Article 8 currencies. As always, though, another door opens. Nobody respectable wants to trade commodities in Central Africa, but ETFs are a growth business. And here we go. Jeff Christian comes into the story again. And according to Jeffrey Christian of CPM, a metals advisory group for the bullion banks, right? It seems much of that silver on hand was converted into ETFs through swaps. And as Christian says, a total of 334.3 million ounces of silver have been swapped for ETF shares so far this year, 322.4 starting in March through August. There was one increase of nearly 20 million ounces of silver into ETF shares that happened at the very end of June. The largest apparent mega swap came from July 21st to 24th, when just short of 25 million ounces slipped into ETF form. The great thing about a bank group having an ETF asset on the books, as distinct from metals or commodity contracts, is that there are fewer compliance people worrying about it, and it is easier to gradually unload to retail. I would say also there is no silver in these ETFs. Try to get your SLV delivered to you if you are a retail investor, right? So what does that all mean? Swapping silver into ETFs through swaps? It's just banker talk for paper shuffling, really. There is no real silver in these ETFs, I would say. Or if there is, there's going to be hundreds of people claiming each ounce. ETFs are just a creation of the bullion banks to try to stop people buying the physical. And these same people are coming out now in the FT again, trying to discourage people from buying silver. Billy wasn't impressed about this second FT article. So this is how he ends the article. Referring to the ETF swaps, Christian observed that not being aware of this development could lead market participants to overestimate the demand for physical metals and assume a more bullish opinion. Or as a now retired silver trader reminds us, silver has always been subject to manipulation. Well, that's right, subject to manipulation by the people you talk to, the people that Jeff Christian talks to, right? The bullion banks. And so I think this is a huge buy signal again for silver. Yes, we've been consolidating for the last month and a half, basically between 26 and 28. I think silver is again ready to take off, just like gold. And I think this article by John Dizard of the FT is very encouraging, actually. As I said back on July 4th, I did the video the day after he came out in July with his article. It was the Financial Times silver bottom, right? This is another Financial Times silver bottom, part 2. So I expect John Dizard to be coming out again with Jeff Christian, maybe early next year, later this year, when silver is at $50, trying to discourage deplorables from stacking silver again, right? Giving all these technical reasons of the ongoings in the paper market of ETFs and swaps. We know, of course, that it's very hard to get physical silver in the retail space. And I think the bullion banks are running scared. And that's why the FT's allowed Mr. Dizard and Mr. Christian out again to try to discourage people. So I actually think there's a high probability that starting next week, we could see silver starting to pick up again. I'm not saying it's going straight to like 30 next week, but I could see us starting to pick up towards that level, just like it started moving up right after Mr. Dizard's Friday, July 3rd hit piece on silver. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great weekend. Take care. Bye.